Today's webinar, Solving the 5 Biggest Challenges in Carbon and Energy Reporting, sponsored by NLX, features Peter Perrault, Sustainability Practice Lead, Global Customer Solutions. Peter's credentials are truly impressive. He's a sustainability management certified professional with close to 15 years experience in the field. In fact, Peter was the first president of the board of directors for the Sustainability Management Association and has been on all sides of the sustainability management table. As a sustainability practitioner within local government, NGOs, industry groups, and global corporations. There's a lot of material to cover, so I'd like to turn it over to Peter. Peter, please take it away.
Thank you very much, John, and thank you everybody who is able to log in for the session today. I'd like to start first with an overview of the Enel Group, tell you a little bit about who we are, and then we can dive into the agenda and the meat of our program for today. If you are not based in Italy, Spain, or Latin America, you may not have heard of the Enel Group, but we are likely one of the largest companies that you've never heard of. You can see some of the statistics here. We're located in 34 countries, and we are essentially the world's largest utility provider, so provider of electricity, and that comes from a variety of sources. You can see we have over 86,000 megawatts of capacity installed. But I would like to also point out that over 43% of that capacity, it comes from renewable energy sources. We are actually the largest producer of renewable energy in the world. You can see some other statistics here on the amount of electricity lines that we have, which can actually reach from the Earth to the moon and back 4 times. Our revenues are currently around over 70,000 billion euros annually and over 15 billion euros in EBITDA. But I would like to pay sort of special attention to the group, going back to the notion of renewable energy and how we've been a sustainability leader for a very long time. The CEO, Francesco Starace, actually sits on the board of directors for the UN Global Compact, and we have been listed on several sustainability indices for well over a decade now. And I bring this to your attention because there's going to be some repeated themes that you'll hear about speaking with investors and telling your sustainability story. And you know, the facts are that Enel Group really practices what we preach. We take sustainability very seriously. We take climate change very seriously. We like to be leaders within the space and share those best practices, which is exactly why I'm here today. You can see we've signed up for several of the SDGs under the UN Global Compact. And we were one of the first 5 companies in the world to have certified science-based targets for our emissions reductions. And we have committed to 100% carbon neutrality by 2050, which is obviously in alignment with the science behind climate change. A little bit about NLX. We are one division of the larger Enel Group, and it was formed several years ago after Enel acquired the companies you see listed here, Demand Energy Networks, Enernoc, and eMotorworks. And NLX really has a vision for the future around energy as a service. And this is in alignment with the larger Enel Group's innovation plan around decarbonization, digitization, urbanization, and electrification. And all of these items tie back to the UNGC and Sustainable Development Goals. But what is energy as a service? If you look at the diagram on the screen, you'll see in purple the value drivers that are associated with energy as a service. So it's meant to reduce your costs, obviously, but manage and mitigate risk, simplify your operations, improve your sustainability performance, and ultimately earn revenue. And then on the outside are the elements or components of energy as a service that NLX would provide. So with that overview, let's take a look at the agenda for today. Ultimately, you know, we called this solving the 5 biggest challenges in carbon reporting. And, you know, depending on where you are on the maturity curve, you may need to make the business case. You may need to justify internal investment in sustainability management and reporting. And what I want to do is help the audience understand this in a broader context, and be able to articulate, kind of see around the corners as to what some of these challenges are, and then have a good game plan in order to be able to address them and solve them. So I'd like to start with the big number slide here, and this is just something to consider. If you look at the volume of assets, financial assets that are managed under environmental, social, governance, investment strategies, you see a number that is approaching $23 trillion, which by comparison is equivalent to the combined GDP of China, Japan, Germany, and the UK. And as further reference, the United States GDP is currently around $19 trillion right now. And so when you think about sustainability, placing it in the context of business and risk mitigation is very important. You need to be able to communicate to investors and articulate a good story for your organization. So if we look at disclosure, this is a reference to respondents to the CDP. You can see that large corporations are increasingly providing disclosure. We're going to get into some more facts and figures on that in just a little bit. But you can see that this is trending upward, and it is something that is absolutely not going away. Furthermore, you notice that the CDP has actually expanded the level of disclosure that they're asking for from corporations into other areas such as forest impacts and water security as well. And so why is this important? CDP represents trillions of dollars of investment interests. And as companies start to, as investors, society as a whole, and corporations start to see the real impacts of climate change, there is a driving need for transparency, and investors want to know that you are proactively managing your business in accordance with what science is telling us is happening. So I'll just put this quote up on the screen. Another thought for consideration. This is from JP Morgan's global research arm. It was published in a report last year. There's increasingly a need for more and more data-driven decisions around ESG performance. And large institutional investors are using this information to make investment decisions. And we'll get into that multiple times over. But when you consider this need for transparency and good quality, solid data, it's interesting because there are many companies out there that are disclosing. We've got a few more facts and figures coming up, but 60% of companies believe that sustainability disclosures do help investors with these comparisons. However, 92% of investors do not agree with that. What does that mean? Investors are not seeing consistency in the data that's being reported. They're not seeing standardized frameworks. And there's a very large push by that community to standardize these things. These figures on the slide are from a PwC report in 2016. But I think if you do a bit of research, you'll find this time and time again. So in setting the context or what the business case is for sustainability reporting and disclosure, there's been a solid business case for sustainability, right? Operational efficiency, mitigating risk, increasing your revenues, attracting and retaining talent. But more and more, we're seeing investors are needing this and making their investment decisions based on it. So your organization needs to mitigate the risks associated with putting this data out there. Having said that, let's dive into the 5 challenges that we've seen. Our organization has surveyed several of our customers. I've been in the industry for 15 years now, and it's amazing to me how these challenges are still in place. Organizations started disclosing emissions performance and other ESG metrics in the 90s, and these same challenges existed then, and they still exist now. The first one is global access to global data, particularly for large multinational companies. That can be a real challenge. But even if you are just in one country or location, then you'll see that same challenge can often persist. And I'm going to go into greater detail on each of these shortly. The second challenge is converting all of that data. So once you've got your arms around all the data, there are a lot of different considerations that you have to take into account in order for that data to be common, standardized, and useful. The third challenge, which is sort of newly arrived for sustainability reporters and practitioners, is the notion of market-based emissions. Again, I will get into greater detail on each of these, but if anybody that's listening to the webinar has been a respondent to the CDP or looked into this, I think you could probably agree that this is certainly a big challenge that reporting entities are facing. The fourth challenge is instructive metrics. Once you've got your arms around your data and you've converted it and you've secured multiple sets of emissions factors for analysis and comparison, what does that data tell you? How do you tell a story with the data, and how does it inform better business-making decisions? And the fifth challenge, which nearly every sustainability practitioner has experienced at one time or another, is winning more budget. You've got your arms around the data, you've converted it, you've captured multiple sets of factors, you've developed some instructive metrics and KPIs, you're able to inform business decisions. Now, how do you use that to tell the story and make the business case to go invest and act on all of the information that you've just gathered? Now that we've covered those five briefly, let's go into a little bit greater detail on each. The first one, access to global data. Multinational companies have very wide ranges of portfologies and assets within their real estate portfolio. They could have owned properties, leased properties, shared space, co-location. There's a variety of different models. And being able to get accurate, clear, consistent data is frequently a challenge that folks are facing. Particularly if you're based in the U.S., certain regions of the world may be difficult for you to get data in. Billing cycles often vary from location to location, and if you're in lease spaces, you may be paying one bill to your landlord and not even receive utility invoices. So this is a really big challenge that companies are facing, and there are ways that we can go about addressing it. I think that, for starters, having one platform, one consistent global system that can gather the data is a big help for folks, and as well, taking advantage of digitization and automation. Before we go any further onto the second one, I'd like to turn it back over to John. We've got a poll set up for the audience.
Thanks, Peter. And this is a great kickoff to the session, and I think a good time to do this first polling question. So we'd like the listening audience to respond to this first polling question, which is, how prepared is your organization to report global energy and greenhouse gas performance? The first option is, this isn't applicable. We don't have international locations. Second option is, we struggle to report across our entire portfolio. It's time intensive and expensive, but we think we can get it done. The third option is, we cannot report energy and GHG performance across all of our locations. And then finally, we're able to report energy and GHG performance across all sites and regions. Please select the response of the four that best describes where your organization is today. While you're doing that, there's one thing I'd like to note, which is Enel has made some additional resources available to the listeners of today's webinar, which can be found in the resources module of your webinar tool. If you click on that, you'll see several downloadable assets with further related information on the topic. Okay, let's take a look at the responses. So 35% say it's not applicable because they don't have international locations. 31% say they're struggling with it. Just over a quarter say they're doing it successfully, and 6% say they're unable to do it. So it looks like almost a third of the audience on the line here, Charles, are in a position where they need some help trying to get this done. What are your thoughts on the distribution of the responses here?
Yeah, it's not that surprising. I mean, it's great to see that there are entities out there that are able to report all of their performance across the sites and regions, or maybe they're not having too many challenges with it. But even for those that don't have international locations, I'm curious to see where they might fit on the spectrum at the national level. But nonetheless, it is telling, and I think that the way that 1/3 said that they struggled to report across the portfolio, it's time intensive and it's expensive, right? And when we talk about reporting season, which is really we're in the midst of it now, right? It's kicking off now. It is nearly a year-round exercise. I think a lot of folks can probably relate to the fact that once you're done and you submit for CDP or DJSI or any of these other large entities, you can't exactly sit back with your heels up and wait very long to get going for the next year's round.
Okay, Peter, that's great. Thanks very much for that perspective, Peter. And why don't you take it back over from here?
Sure. So we talked about and heard some feedback from the audience on getting your arms around the data. The second challenge is really converting the data. Now, if you look at this slide, it's got a lot of words on it, but really we're looking at 3 columns, and this is 3 of what could be several more columns. The first one is currency. How do you convert the currency to be able to understand the financial impacts of your energy consumption? The second one is the various commodities that are out there, right? If you're talking Scope 1 emissions, there could be, upwards of 20 to 40 commodities that you have to gather data for. And then there's the unit of measure, right? How do you convert, say, decatherms into kilowatts or kilowatt hours? Now, obviously, there are standards out there for converting all of these units of measure, but do you have a reliable system for doing those conversions? Is everybody in your organization doing it the same way? Oftentimes with various platforms, you have people manually entering data, which also causes a challenge because they may not be entering it properly. But when you think about all the various invoices that you may receive, they're being sent to a central location. You have to deal with language and currency conversions and things like that. So converting the data becomes a big challenge. And again, having a robust system in place that's able to address that repeatably and scalably is going to make your lives much, much easier. I said we go back to some investing statistics. This is from the State of Integrated and Sustainability Reporting from Harvard Law School. We all know that large companies, the S&P 500, the vast majority of them, roughly almost 4 out of 5, are issuing sustainability reports and or disclosing publicly to various reporting entities. Of those, 97% of those companies are customizing their reporting models instead of using a single framework. If you drill down into that a little bit more deeply, only 2% are following one model closely, whereas almost half of them are referencing 2 or more different reporting models in their sustainability reports. Now, why do we think this matters? Again, going back to the previous slides with quotes from JP Morgan Global Research and the PwC report, investors find this hard to understand. And you need to be able to tell a good story to attract and retain talent, to draw investors, and to be able to articulate that you are mitigating and managing the risks associated with your business. This is just a quick example. There are certain emissions that may be covered. Let's assume that you are based in the United Kingdom and you have signed up for some climate change agreements in order to mitigate your exposure to the UK CRC, which is probably going to go away, but then you also might be subject to emissions reporting under the EU emissions trading scheme. So they might be asking for different sorts of information. How do you convert all of that? How do you make sense of it? A lot of it is going to be related to your inventory management plan, obviously, and what the regulations state. But since there's a regulatory environment that covers multiple layers of your organization, you need to ensure that that data is accurate and complete and addressing what the regulations are requiring. Challenge 3, market-based emissions. So now you've got your arms around all of the data. You've converted it to the proper formats and currencies and whatnot. What is this market-based emissions that CDP has introduced? It was a voluntary concept in reporting your Scope 2 emissions for several years, but now it has been mandated by the CDP. And anybody who responds to CDP probably recognizes this slide. But essentially, the traditional format for reporting your emissions was using location-based emissions factors. What are location-based emissions factors? They are essentially the grid average emissions factors. So in the United States, it would most commonly be the US EPA eGrid data set. Internationally, they're usually reported at the national level using data from the IEA. However, increasingly, we're seeing more and more governments publishing their own national emissions factors, either by province or region, et cetera. And market-based, so that's the location-based method. Market-based is newly introduced by the CDP, and it's really designed to reward those entities that are going out into the market and procuring renewable energy. You're making a market decision to either pay a green tariff if you're in a regulated market, or in a deregulated market, you are signing PPAs, VPPAs, et cetera. And that approach is going to reflect the energy procurement decisions that your organization is making. So you can think of the location-based approach as a control to ensure that you're comparing apples to apples across all companies, but then market-based is going to really highlight or differentiate the financial decisions you're making and how you procure your energy. There is a ton of words on this slide, which I will not read to the audience, but we wanted to include it because, as John mentioned earlier, we provided a number of resources that you can download, and these slides will be circulated and available after the webinar. And so we wanted to have a takeaway with some information for folks that might have more questions around this. Market-based emissions is particularly challenging as well because there's a hierarchy of data quality. And in speaking with lots of organizations, they constantly face a challenge of understanding, am I in a regulated market or a deregulated market? Do I need to go report market-based factors if I'm in a regulated market? What is the standard? My invoice says that I have green energy. I don't really know what that means. Sustainability managers are not energy market experts necessarily, and energy managers may not even be aware of the decisions that they're making and how they impact your sustainability decisions. And so it's important to understand the framework, the data quality hierarchy, and then what is going to constitute valid data when you go about reporting market-based emissions. So just a final slide on that. Again, you want to identify the sites that are going to require reporting market-based emissions. Under the GHG protocol, Scope 2 guidance, if you are in a regulated market, you are able to use a location-based value. However, increasingly in the United States, we're seeing that even regulated markets, I believe there's 14 or 15 at least, are now offering green tariffs, and they're still offering some sort of choice for you to make in your energy procurement decisions. But for sites that are in competitive markets, there are a variety of different things that could go into that market-based emissions value. You've got supplier-specific emissions factors. You've got energy attribute certificates, commonly referred to as RECs in the United States. And then there's various other contractual instruments, power purchasing agreements, virtual power purchasing agreements, et cetera. If that doesn't work, you might have to default to the residual mix, although those values have recently come under a bit more scrutiny for how accurate they are. So having gone through the global data access component, converting your data, and now trying to understand and wrap your arms around market-based emissions and what that means for your organization, I'd like to pass it back over to John for another poll question.
Thank you, Peter. Here's a second poll question for our listening audience. Is your organization prepared to report market-based emissions, which is the topic that Peter just covered in the most recent part of the presentation? The three options are: we have not yet considered how to report market-based emissions. Market-based emissions reporting is on our radar, but we haven't yet figured out how to do it. And finally, we're currently reporting both location-based, and market-based emissions. Please select the option that best describes where your organization is at this point regarding your preparedness to report on market-based emissions. Okay, let's take a look at the responses. This is interesting. It's evenly split across all three responses, Peter. What are your thoughts on that? Is that what you expected? Is it surprising?
That similar to our previous poll question. Congratulations to those who are currently reporting both location and market based. It's great to see that almost 34% of the audience has figured out a way to address this. But I think that this is about what I would expect, right? There's a maturity curve. My assumption would be that the 34% that are currently reporting both may have some challenges, but they've figured it out. And then there's some folks that have it on their radar. It's an even split. It's a bit to be expected, I would say.
Great. So we've got about a third that are still figuring out how to do reporting, and just over a third that are trying to figure out how to do this market-based piece.
So if you look at it another way, John, we've got two-thirds of the audience that hasn't quite figured it out yet. So for those folks, you're in good company. So our fourth challenge, we talked about global access to data, converting your data, managing and addressing market-based emissions. The fourth one is instructive metrics. Now that you've got your arms around the data, you're starting to figure this out. How do you use the data to make like-for-like comparisons against your portfolio? How do you use it to tell that story to your upper management and to investors? The screen grab that you'll see on the right here is from GRES, which is the Global Real Estate Sustainability Benchmark. GRES started in Europe, must have been 10 years ago maybe, and has since been really pushed out by pension funds, institutional investors to the real estate investment trust community. And they really use this data that companies are reporting to make informed business decisions about what they're going to invest in. There's also assets and infrastructure portions of the GRES report. And again, this data needs to be clean, clear, consistent for you to inform your own business decisions and for investors. So what kinds of decisions might you be making? You need to determine which projects are going to have the best impact. You're going to need to evaluate distributed energy resources or PPA options. Where do you want to allocate your capital? All of these things are important, and it does start with your inventory management plan and how you structure that so that you can compare your GHG inventory year over year. However, there are other folks that you're going to need to share this information with to inform their decisions and, again, to tell your corporate story. And with that, I believe we have another poll question, so I'll turn it back to you, John.
Yeah, this is the final poll question, Peter, and I know you've got some great content that's immediately going to follow this. Our final poll question is, how well do your sustainability metrics inform your current business decisions? And the responses are, we're not yet tracking sustainability metrics at the corporate level. Our metrics are a yardstick that tell us and our investors how we're performing, but they don't inform future actions. Or the third choice, our metrics are closely connected to our business and help us make business decisions. So please select the response that best reflects how well your sustainability metrics are informing your business decision making. And the audience response here is in favor of metrics are a yardstick, but they're not necessarily informing business decisions, followed by the group of about a third that are not yet tracking sustainability metrics. And then finally, metrics are closely connected at just about 25%. So Peter, why don't you take us to what I know is an important part of your content?
Sure. What this all comes down to, and it's unfortunate to hear that the majority of the folks are not using that data and KPIs and metrics to inform business decisions, because that is what investors are really asking for. And I know for Enel in particular, our sustainability plan is tied to our industrial strategic plan. And investors were reporting that out to the street. And that's why we've made a decision years back to be carbon neutral by 2050, right? Because there are physical impacts, there are financial impacts, there are regulatory impacts, all associated with your risk management strategy and how you perform on environmental and social governance issues. So how do we use all this data? How do we quantify the value of proactive sustainability performance and investment in order to secure more budget and allocate capital and make better decisions and attract investment? This snapshot here you see is from DJSI. And I think what it comes down to is investors want to see alignment of your goals and your strategy. And so they're increasingly asking, what is the highest level within your organization that has responsibility for sustainability performance? Is it tied to incentives? How do you incentivize your employees? And for the sustainability practitioner who has to report data up oftentimes to other levels of the organization, I think it's really important to speak the language of the executives within your company and speak the language of the investors. Anybody that's been in the industry for a while knows that sustainability is far from a warm, fuzzy, feel-good type of area in business. It hasn't been for a long time. We referenced in the beginning the volume of capital in investment ESG investment portfolios. It's staggering, really. And so it's important to be able to speak that language and ensure that you are communicating a good story. And what does that story look like? Similar to the standard business case for sustainability, the first thing is resource management. You want to be able to use fewer resources, lower your OPEX, and improve your EBITDA. But if you don't have your arms around that data, how are you ever going to be able to do that? And the second, which I found very interesting, a CDP report recently said that companies that report to the CDP save on average $1.2 million in annual loan interest charges. So saving over $1 million, what does that tell you? It tells you that investors are paying attention, and when you're disclosing and showing strong management and proactive management at the higher levels of your organization, then you are less risky to them, and you're managing your financial performance, your environmental performance, your social performance better. Therefore, you're getting better loan rates, securing that capital that you need to reinvest in things like innovation and new markets. What else have we seen? We've seen almost nearly over 35% growth in sustainable investment funds. We referenced again earlier in the presentation that investors are using this data to make decisions, and they're building out SRI portfolios. And 84% of global asset managers are looking at ESG investments. And finally, what we've talked about before is risk management. So there's physical risks associated with climate change, obviously, but there are also regulatory risks. And this is a trend that we've seen continue to tick up with the signing of the Paris Accord. There are national bodies that are making firm commitments. And there's also, state level, regional, local level regulatory burdens around this. And so it's very, very important to have your arms around the data, have accurate data, understand how it's going to inform your business, and then making those business cases to the highest levels of your organization in order to secure budget. What do we think? Do we think this trend is going away? Absolutely not, right? As organizations become more savvy and more skilled at gathering this data, managing it, reporting it, telling the story to investors, talking to regulators, the bar continues to rise. And you have to demonstrate that you can perform, you have transparency into your own organization in order to inform decisions, and that you're going to act on it. It's similar to what I refer to as de facto regulations. Take, for example, ISO. The International Organization for Standardization has the 14001 program, which is around environmental management systems. And if you look back to, say, the 80s or early 90s, that might not have been the norm until companies started to press on their value chain to say, we want to know that you are operating responsibly and that you're managing your environmental impacts. So we're only going to do business with you if you're ISO certified. That's not a regulation, it's not a law, but when a $50 million deal is put on the table, then it changes the economics of investing in that program significantly. And, we highlighted this at the bottom with the Walmart Gigaton project. It's a value chain risk. And you have to be able to demonstrate resiliency to investors in order for them to feel comfortable allocating capital to your company. I think this is my final slide on this topic before we start to wrap things up. This is more specific to NLX and some of the activities that we do. How do we look at this? Getting your arms around the data. There's a foundational process for this, which is gathering all of your utility invoices, your electricity bills, your natural gas bills, any other fuels that you may be using. And that is really around some basics, right? Being able to pay your bills on time and understanding your basic consumption. But then as you look at that consumption, you're able to get better insights into how your organization is operating. A utility bill management system can be used by several different entities within your organization. It could be used by AP, finance, procurement, folks that are doing budgeting and accruals. It could be used by facility engineers to look at their demand charges and power factor costs and try to understand how their plants are operating. It can also be used by sustainability managers for emissions reporting. And then as you look at the higher level, the executive level of things, you're gaining more value out of validated data, plus finding additional savings opportunities and enabling the smart reporting with global coverage. You've now started to take those savings and put them perhaps into a green fund within your organization, which can be used to make more sustainability improvements to your portfolio of assets, and using that data again for disclosure to investors as well as your executives. So I've got just a couple case studies here that I wanted to take a quick look at. This is a global industrial manufacturer that NLX works with. They have a very large portfolio, as you can see, over 350 locations in over 45 countries. A lot of data going into their utility bill management system. We do engage with them to ensure that data is of a very high quality. We provide various reports to them, offer some guidance as it relates to what they can do with that data, where the opportunities are to perhaps change suppliers, looking at PPAs, VPPAs, et cetera. And we do also support third-party audit and verification for their data. And the results have been fantastic. They've been listed on the CDP Leadership Index, or CDLI, for several years. The variance in their data was total variance of 0.02%. And all of the additional QA, QC, and bill validation that their data has undergone has also uncovered over $750,000 in savings. And so what can be done with those savings but reinvest in either capital projects or other mechanisms in which they can further improve their performance as it relates to energy and GHG. Second case study is a global automobile manufacturer. And you see the numbers here. They really speak for themselves. We've been working with this organization for over 10 years now. And they are finding new opportunities consistently for ways to manage the data holistically and inform better business decisions, as well as meet regulatory compliance standards using the utility bill management platform. So just trying to wrap it all up here and leave some time for Q&A. I think there's 5 takeaways that we wanted to leave you with. And again, there are other resources that you can download, and we'll circulate these slides later. But the first thing, which is always the most critical, is getting the right people involved in the conversation. When we talk about just the utility bill management system, again, you could have energy, water, waste, recycling, fuel data, electricity data, et cetera. So that's covering your EHS, it's covering your procurement, it's covering your facilities and operations, it's covering your sustainability group, your finance, your AP. That's all from one platform. And then who are we trying to communicate to? You might need investor relations to be involved. There was a letter that the CEO of BlackRock, Larry Fink, issued to all the companies in which BlackRock invested, saying that companies have to think about their purpose in society and what their role is. Again, we're going back to storytelling and investors. So you need to make sure that the risk management folks are involved. Everybody's sitting at the table and contributing to the conversation to build that consensus. A couple of slides ago, I talked about identifying savings or opportunities for improvement, and then reinvesting that capital into sustainability and energy projects. Very key. Some companies are putting a price on carbon. We're seeing that increasingly, and being able to reinvest is going to further propel better decision making, better performance. The third thing is really around seeing around the corner. Right? Understanding that the regulatory requirements and requests from the investment community are not going away. And increasingly, they're going to ratchet up and keep raising that bar. So having the right data, making informed decisions with it, and communicating that is going to help you be more prepared for what's to come next. The fourth thing is to take advantage of the efficiencies that exist with a vendor-partner relationship. I talked in the beginning about energy as a service, and you want to reduce the administrative cost and the time that it takes to gather this data to manage it. It's really kind of surprising how many large companies are still using multiple systems. They're using Excel. It's taking multiple FTEs for them to gather this data and put together a report. Take advantage of your partners, lean on them, and allow your operating teams to focus on what they do best. And then the last one is to align your resources and understand what story it is you're trying to tell. What does your management want to hear? What are you trying to tell them about how the company operates? What do your investors want to hear? What do all of your stakeholders want to hear? Right? You need to have good data, and you need to tell the right story, and you want to ensure that all of those things are aligned from planning to execution and then improvement.